what we're going to be going over here is governmental fund accounting, and we're going to be looking at the different journal entries that would have to be made during the accounting period. And really we have three basic types here. We're going to have the budgetary journal entries that we're going to have, and then we're going to have operating journal entries that for the operations here of the governmental body, and then we're going to have closing entries. And what we're going to deal with here, we're going to be looking at that general fund here. Start out at least with the general fund here for the general operations. And when we're talking about a fund accounting, this is what we have to deal with here. We got governmental funds. We got 5 basic types here. We got the general fund. That's the example that we'll start with here, and then and that's the day-to-day operations here of the municipality or governmental body, like the city's day-to-day operations. And then we're going to have a special revenues fund. That's where specific revenues are being collected for a specific project, like building a new highway, and they're being set aside here in this special revenue fund. Then we have the debt service fund. That's where we're going to have to pay for our long-term debts. And then we have a capital projects fund. That's where you're investing in long-term assets, like maybe a new library or a new fire station, and you account for it through the capital projects fund. And then you would have your permanent fund here. This is where some money is being set aside here by the municipality, being invested, and you're expecting a return on that investment. Okay, so first let's move over here and let's look at the basic entries that we'd have to make here when we're talking about governmental accounting. So first you're going to have to be recording the budget, and then secondly you're going to have to be recording your revenues and your expenses here. And then thirdly, you're going to have possibly some transfer between accounts here, transferring funds between accounts, and then you would have the closing of the accounts here. And what we want to do is we want to focus on the account names that we're going to be looking at here, and any debits and credits, increase and decreases in these funds. Okay, so let's look at this. First, we'll start with this budgetary accounts to record the budget. This is where you're going to set it up at the beginning of the period, and it's closed or reversed at the end of the period. And there's never any impact on the fund balance. And what we're talking about the fund balance, if you compare it to for-profit financial accounting or for-profit corporation here, that would be like its retained earnings. And there's no actual transactions recorded in these budgetary accounts. It's only for budgetary purposes here. The actual transactions during the period here are recorded in separate general ledger accounts, but they're related to the budget. But when we're talking about this budgetary operation here and recording our budget here, it's different from a for-profit corporation or regular financial accounting. There you have a budget, but you don't record it. But when you're talking about governmental accounting, you're going to be recording a budget. And what we're going to be looking at for our budget here are really 5 different accounts. And we're going to have our inflows shown over here and our outflows shown over here. Inflows would be the resources or the cash inflows, and this would be cash outflows here for the municipality. But before we get into those accounts here, what we want to make a point of it here, when we're recording this budget, the budget items have an opposite debit and credit from the normal entries for governmental accounting or the related accounts. Or let's look at it in this terms here. Let's look at this as estimated revenues control. That would be like the revenues here coming in to the municipality or the governmental body. So what we want to look at here, it's similar to when we're talking about reversing entries here. When you think of revenues here for-profit or on your financial statement, financial accounting for a for-profit corporation, your revenues here would have a credit increase here. Here we're showing a credit decrease here for our budgetary items. And likewise here for the debits. For normally you'd have a debit decrease here. Here we're showing a debit increase or debit plus. So just remember here not to be confused when you move into your regular entries here for governmental accounting, your debits and credits are reversed from what is shown here in the budget. So what we're going to start with is our inflows here. That would be, and remember the names here of these accounts here. These is a key to this governmental accounting. We'll start with the first inflow here is the estimated revenue control. Again, for the budget here. Well, what is that? that would be the revenue inflows here into the municipality. That's the increases, that would be increases that do not have to be repaid here. Any increases like taxes collected and so forth. Whatever revenue that the municipality or the governmental body is looking at, that's where you're going to record it here for the period here. And I'm just going to throw out some numbers here. 100,000. Debit or increased your estimated revenue control here for $100,000. Now, moving down to our second one here, that would be the estimated other financing sources. Key name here. So what we're talking about, that would be the source inflows here. That would be like issuing long-term debt, issuing bonds here by the municipality, and then they would get a cash, sell the bonds and receive some cash. Or they could be selling capital assets, getting an inflow. Or thirdly here, you could have an interfund operating transfer in. You could be transferring monies in from other inner funds, other funds that are set up here by the for the municipality. Okay, so those would be our inflows here. Now moving over to the right side here. Again, I've got everything showing on, and as first off, this estimated other financing sources, I've just got a zero amount here, not to complicate our problem here. I'm just using a zero amount here. But that would if you had any of those source inflows, that would have to be included in your budget here. Then moving over to our outflows. Okay, so what we're going to start with would be our appropriations control. Key name here, appropriations control. That would be the expense outflows. That's whatever the city is legislated here or authorized as expenditures for the period that we're looking at, for generally for a year here. So what I'm showing here in this case here, again, credit here is an increase, debit decrease. Opposite are outflows here, are opposite are inflows and debits and credits. So this is where we're going to get our balancing amounts here for our budget here. So in this case, let's just say there's 97,000 here. I'm just throwing out these numbers. They may be a little small. You could put that 97 million if that would be better here. But credit it for 97,000. So that would be the expense outflows. That's what's been authorized as to be spent here for the year here. So that's what we'd have for, and remember, that's appropriations control. Then we move down to our other account here, estimated other financing uses. Before we talked about estimated other financing sources, now this would be uses here. And that would be, again, our outflows. So what we're talking about, the source outflows, that again, this would be interfund operating transfers out to other governmental accounts. The other one, we had transfers in here as inflows. Now we're talking about transfers out. And in this example, I'm just throwing out credit here, increase it for $2,000. So what we want to do here is we want to compare our inflows with our outflows. In doing that here, we're going to come up with our fifth account here, and that's going to be our budgetary fund balance here, again for the budget here. This is where we're going to be looking at if the estimated inflows are not equal to the estimated outflows that we had up above here, you're going to either debit it, reduce it here, or credit it, increase it here. So what we've done here, that would be, it's showing under our outflows, outflow side here of the budget here, and you can see the debit here, credit plus here. So how we're going to come up with these, what should be included here in our budgetary fund balance. So again, this is where we're looking at our inflows versus our outflows. So take your inflows and subtract out our outflows. That's going to give us our budgetary balance. So if we go back to our example here, you can see our inflows, well, we only had that estimated revenue here of $100,000. No estimated other financing sources. So that has to balance. Our balance in our budgetary fund account here has to balance with our inflows here. So outflows have to balance with our inflows. So appropriations control, we had 97,000 here, and estimated other financing uses, we're going to transfer out 2,000. So we got 99,000 here versus 100,000 here on our inflows. So balancing amount is going to have to be a credit here to the budgetary fund balance here of $1,000. So we get a balance between our inflows and our outflows. So what you're going to see here, looking at our budgetary fund balance, it's greater here, credited by 1,000. So we have a greater inflow here. Okay, so that's how that works. If it was less, then we'd have a greater outflow. If we had to balance it with the, if we had to balance it here, we'd have a greater outflow. So this depends. Just look at how you've got your debits and credits fall out. Okay. All right, so then the other thing, when you're dealing with this budget, you set up the budget here, your 5 accounts. Remember, there's no transactions that are taking place in these accounts. At the end of the period, you close these accounts by reversing whatever entry was made to record it here. So in this case, you can see I just reversed everything out here. Whatever was a debit here got credited out or reversed. So anything that's sitting in the budget, no transactions going on for the period, nothing's recorded in here. You're all going into some other general ledger accounts. All you want to do is just close them out. So whatever's sitting in the credit, if you had a debit here, just credit it out. A credit here, just debit it out, and then everything is zeroed out, and you would start with a new budget at the next accounting period. Okay, so that'll take care of our budgetary accounts. Just remember, you have to set these up. They're different than for-profit corporations where they don't have budgetary accounts, but in the case of a governmental fund accounting, you have to set up the budgets, and you have to the reason is you have to determine what your estimated revenue inflows or your estimated inflows would be here versus your outflows here. So that's really what you're looking at. So people can look at it and see what's going on in just the overall view here when you're talking about governmental accounting. So really the key is you have to come up with all those numbers. But we looked at them here and we just defined them here in just going an overview of what they include. Okay, so that'll end our subject here on the budgetary accounts. Now let's look at governmental accounting for revenues, and this would be for tax revenues, and we have both the cash and the accrual basis. Now when we're talking about the accrual basis, governmental accounting, you're talking about modified accrual. This is where you cannot accrue revenue unless it's available and measurable. Okay, so it would involve these accounts here when you're talking about tax revenues here. So you're going to have your cash account, of course, and then you're going to have your taxes receivable here, the current amount here, and that would be again an asset account. And then you have to set up an account here, estimated uncollectible taxes, contra asset account, or an allowance account to your tax receivable. And then you'd have to recognize as revenue here, you're going to have what you call a revenue control account here. And that would be similar to revenue on the income statement for a for-profit company. But the difference here with this revenue control account, you can only recognize revenue or accrue revenue when it's available and measurable. Okay, so let's look at our example here. Let's say start out with our cash collections here. We collected sales tax. That would really be like sales tax here of $11,000. So we move over to our cash account. We debit that or increase it here for $11,000. And then in our revenue control account, we'd credit it here for $11,000. Now, let's move down to our modified accrual here. So we're going to levy real estate tax here of $108,000. And we're going to estimate that that $8,000 of the $108,000 is uncollectible. Okay, so what we have to do here, we go over to our taxes receivable, debit that here for $108,000, and then we would have to set up our uncollectible or our allowance here for those receivables. We'd credit that here for $8,000, the estimated uncollectible amount. And then over in our revenue control, the balance would go to a credit here or increase it for $100,000 because that is what we're saying is available and measurable. Okay, so now let's go down and we actually collected $106,000 of the $108,000 worth of real estate tax that was levied. So what you're going to do here for your taxes receivable, you'd credit it or reduce it for the actual amount collected here, $106,000. Now, let's move over to our revenues control account. Remember, we originally recognized $100,000 here of the $108,000 levied. We have to increase that here by $6,000 because we actually now collected $6,000 more than we originally estimated. So we're going to have revenue control total collections here for that real estate tax at $106,000. Now we have to go down and make an adjustment here to the estimated uncollectible tax. So originally estimated $8,000 here. Now the adjustment is we really have only $2,000 that we are uncollected. We collected 108,000, we collected the 106,000. So the adjustment goes into estimated uncollectible taxes, debit that here for $6,000. So our net amount here in estimated uncollectible taxes is only $2,000. So the only thing we want to take away from this here is that you really have to be concerned with is when you're dealing with governmental accounting, this revenue control account, you can only recognize revenue when it's available and measurable. Okay, so that'll summarize our governmental accounting here for revenues. What we're going to be looking at here is governmental accounting for expenditures using the encumbrance system. So when we're talking about this encumbrance system, we're setting up two special accounts here. The first one is going to be here, this encumbrance control for estimated expenditures, and that has to do with the POs that we're issuing here. And then along with that, we're going to have the fund balance reserved for these encumbrances or these expenditures. And what we're doing with these two accounts here, we're setting aside monies here, or they work in conjunction here with the unreserved fund balance. And this unreserved fund balance, that's similar to retained earnings when you're talking about profit accounting. Okay, so along with this encumbrance system here, we'll go down and look at our other accounts that we have to deal with here. Of course, we're going to have our cash account here for expenditures, and then we're going to have as our liability here, we're going to have vouchers payable, and then moving over to our expense that we're actually recognizing here, that would be our expenditures control, and that would be similar to expense here on the income statement for a for-profit corporation. Okay, so let's go and let's look at this, start with this encumbrance control account here along with our fund balance reserve account. Okay, so what we're doing here with this encumbrance system here, this encumbrance control for the estimated expenditures is essentially a contra account to the unreserved fund balance here. So you can see the debits and credits here. So as when I'm talking about contra here, any increases in our encumbrances control or estimated expenditures here, debit plus, is going to reduce here the unreserved balance here, unreserved fund balance here. So we're going to look at it and we're going to follow through a problem here. So let's start out with our problem here, how we'd handle it. So let's say here we approved purchase orders for goods and services for $82,000. So what we would do here, we take and we debit or increase our encumbrance control for these estimated, everything's estimated here, estimated expenditures of $82,000. So debit that here, and along the associated credit would go to the fund balance reserved here of $82,000. So we reserved some fund balance here of $82,000, and we set up our encumbrance control account here for $82,000. Okay, so along with that $82,000 here, we have to mention here that it also includes a X machine here, a special machine costing $6,000. Okay, so now we've come along here and we've been billed $75,000 for goods and services originally estimated at $71,000. Okay, so going up to our control accounts here. Again, we were billed for $75,000, but originally estimated at $71,000. So this encumbrance control, remember, that's based on estimations here. So the estimated amount, credit or reduce our encumbrance control here by $71,000, and then our fund balance reserve, we can debit or reduce that here by $71,000. So what we're doing here, we're reversing these entries here, but they're based on the original estimate. Everything's based on the estimates here, and we're working off the original estimates. Okay, now we come along here and we're billed, what was it? We talked about that. We were billed $75,000 for goods originally estimated at $71,000. We've taken care of that. Now, we come along in this special machine here that was originally costing $6,000. This X machine here was delivered with a bill of $6,500. So what we do here, and again, going back to our control accounts, we work off the original estimate we have here. So we've been billed here for $6,500, but we would enter it here in our encumbrance control here for $6,000. Reduce our encumbrance control here by $6,000, and then again our fund balance reserve, we'd be reducing that here by $6,000. Okay, so what we've done here, we come to the end of the year here, let's just say, and how this encumbrance control works here is that you net out your debits and credits. In this case, we have a $5,000 ending balance here. We have $5,000 worth of estimated expenditures still outstanding. So what we're talking about here when we talk about this balance here at the end of the year here, same for our fund balance reserve here, that's based on any outstanding purchase orders for any goods or services not yet delivered. So what we would do essentially here, and how this encumbrance control affects our unreserved fund balance as a you can look at it as a contra account here. So what you would do here, you had the encumbrance control here, a debit of $5,000, credited out here by $5,000, so the debit would go to the unreserved fund balance here, and that debit here would be reducing our unreserved fund balance by $5,000 because we still have that encumbrance or those estimated expenditures outstanding. Okay, so we've taken care of our encumbrance control in our fund balance. Now let's go down and let's look at how we'd make our other entries here. So let's start with, okay, our vouchers payable here. So let's say that we were billed $75,000 for goods and services originally estimated at $71,000. So what we would do here, vouchers payable, we'd credit that here for what were the actual billed amount here of $75,000. And then we go over to our expenditures control account. Remember, this is similar to the expense here on the income statement for a profit corporation. We debit that here for $75,000. Okay, now we recognized our expenses here, but now we actually, this is the case here where the invoice was actually approved here or for $75,000. We actually approved it here for $75,000. And would we do a vouchers payable, would debit or reduce that here for $75,000, go to our cash account, credit that, or reduce our cash here for $75,000 because we now approved that invoice. Okay, now let's go over here and let's look at this X machine that was delivered with a bill of $6,500. So again, in our voucher payable, we set that up as a payable or a liability here for the billed amount here, $6,500. Then go over to our expenditures control here and debit or increase that here by $6,500. The actual billed amount here. But we're not reducing our vouchers payable because the invoice payment is not yet approved. It has to be approved before we can go in and pay off this payable here and reduce our cash or pay it in cash. So it isn't paid or it isn't approved yet, so therefore we're not recognizing it as a reduction in cash here. But we did recognize it as an expense here as under our expenditures control. Now, again, just looking at this X machine delivered with the bill here of $6,500, this X machine is going to be carried in our general fixed asset group here under your equipment here for $6,500 debit amount, and then we'd have an investment in our assets here, $6,500 credit amount. Okay, so let's just go back again and look at what we're talking about here. So with this, we can just go back and look at all our accounts. Just remember when we went through these examples here and we made our entries. So just remember, you go back to your encumbrances control here in your fund balance and you can look at your entries there, and then you can match them up with the other accounts here, our cash, our vouchers payable, in our expenditures control. So they all have to balance and match out here, but when you're dealing with governmental accounting, you have to set up these control accounts here for the estimated expenditures. And just remember, this encumbrance control acts as a contra account here to the unreserved fund balance, or really similar to the retained earnings here of a profit for a profit company, for accounting for a profit company. But remember, with the expenditures control and your fund balance, you enter it in here at the estimated cost, and you make your reductions at the estimated amounts here when you're trying to determine your ending balances here. Whereas moving down to your vouchers payable and your expenditures control accounts, you're doing those at the actual amount. So that's really the difference between this encumbrance control in your fund balance reserve. That's based on the original estimated amounts, whereas when you're dealing with your payables here and your expenditures that you recognize as expenses here, that's done here at the actual amounts or the billed amounts. And for your vouchers payable, just remember, you can't pay it unless it's still approved, or you can't pay the voucher unless it's approved. You can't spend the cash unless there's an approval. You recognize it when it's billed, but you don't recognize any cash outflow until it's approved. Okay, so that'll summarize our governmental accounting here for expenditures using this encumbrance system. What we're going to be going over here is temporary versus permanent transfers of funds. This is where we're going to be transferring between governmental funds. So we've got these various governmental funds up here, and we can transfer between them. And for example, we're going to be transferring cash. So starting with a temporary transfer, this is where we're going to be transferring from the general fund to the special revenues fund on a temporary basis here. So what you have to do is you have to determine these accounts here. You're going to have a due from account here and a due to account. So for the general fund, you're going to have a due from the special revenues fund. In this case, it's going to be for $3,000, and then you're going to have a reduction in cash here for $3,000. And we're going to look at this in T account form here to understand our debits and credits. But first, let's just go through understand our account titles. And then for this temporary transfer here in the special revenues fund, this is where you're going to set up a due to the general fund account here, and you're going to be, in this case, receiving $3,000 in cash. Okay, so now moving down to our permanent transfers here. Again, from the general fund, we're going to make a permanent transfer to the capital projects fund here. So when we're talking about permanent transfers, this is where we got to have to set up a financing uses account here and a financing sources account here. So in our general fund, we're going to transfer $2,000 here to the capital projects fund. So what we have to do in our general fund, we have to set up the other financing uses control account here, and then we'd be reducing our cash here for $2,000. And then in the capital projects fund, this is where we're going to have to set up an other financing sources control account here, and this is where we're going to be receiving $2,000 in cash. Okay, so let's go out look up at our T accounts here. Again, temporary versus permanent transfers of funds. What you want to do is you want to check your account titles, difference between temporary and permanent differences here, and look at your debits and credits. So what I've got everything laid out here in T account form. So I'm showing inflows here. That's going to be the fund that's going to be receiving some cash here, and that's on the left side here, and I'm showing it in T account form here. So for the inflows, for the both temporary and permanent accounts here, debit's going to be a decrease here, credit's going to be an increase. And then for our outflows here, this is the fund that's going to be sending cash over here to the fund that's going to be receiving it here. So those are going to be outflows here. And again, when we look at our debits and credits, this is going to be a debit increase here for both the temporary and permanent differences here, and a credit decrease here. And then, of course, looking up at our cash accounts here. For our outflows, we're going to have a credit reduction in cash, and for inflows, we're going to have a debit increase in our cash. Okay, so let's first look at this temporary difference here. This is the case where the general fund is going to send $3,000 here over to the special revenues fund. So what you're going to do in the general fund, you're going to have to set up your title here, your account, due from the special revenues fund. So there you're going to debit this due from special revenues account here for $3,000. And then, of course, going up to your cash, you would credit or reduce your cash for $3,000 because you're going to send $3,000 over to the special revenues fund. So in the special revenues fund here, you're going to set up the due to the general fund here, again, for this temporary transfers. And that's going to be a credit here of $3,000. So this is the transfer. And then over in our cash account here for the special revenues fund, this is where you're going to increase your cash here by $3,000. And for the general revenues fund, this is where you had a credit or reduction in cash of $3,000 that was sent over to the special revenues fund. Okay, so remember, for temporary differences here, you got to set up here for your outflows here for the fund that's sending out the cash to the other fund. In this case, it's a due from, in this case, the special revenues fund. And then for the inflows of the fund that's receiving the cash, you do the due to. in this case the general revenues fund here that's sending the cash. Okay, and then the other thing, when you're talking about these temporary transfers here, we have to understand that the due from and the due to accounts are not close to the fund balance at the end of the year, whereas the permanent transfers, we're going to look at those are actually, those uses and sources accounts are close to the fund balance at the end of the year. And when we're talking about the fund balance, that acts as retained earnings. If you're looking at a for-profit company, you'd consider that retained earnings, but when you're looking at it in terms of governmental accounting, you would call it fund balance. Okay, so we understand the temporary transfers here. You have to understand your account titles, your debits and credits, and what you have to determine what fund here, that would be the outflow, and what that's sending the cash, and you have to determine as inflows what fund is receiving the cash. Okay, so that takes care of our temporary differences. Now moving down to our permanent differences here. Again, this is the case where the general fund is going to send $2,000 over to the capital projects fund. So what the general fund has to do, they have to set up this account, other financing uses control account here. So that they would debit here for $2,000, and then up in their cash account they would have credited or reduced it here for $2,000, their cash account. And then the fund, that's the capital projects fund, that's receiving the $2,000 here, is going to credit their account here, other financing sources control account here, for $2,000. So that's how we take care of the permanent transfers here. Again, remember, a permanent transfer, the uses and sources account are close to the fund balance at the end of the year. Okay, so let's understand here, just understand your titles here. So if we understand here for the temporary transfer, the general fund here was transferring it out, they set up the due from, the fund that's receiving the cash here that they're sending it due from, in this case the special revenues fund. And the special revenues fund here is setting up the due to, in this case the general fund, because they're receiving the cash but they're going to have to pay it back here. Whereas the general fund here is due from, so they send up, just understand those nomenclatures here for the temporary difference. And then moving down here again for the permanent differences here, again the general fund here is sending the cash over to the capital projects fund. So this is other financing uses. They're using this cash here by sending it over to this other fund. And this fund that's receiving the cash here, this is where they have other financing sources. So it becomes a source to them here. So that's kind of easy to understand here. General fund is using cash as an outflow, sending it over to the capital projects fund, and the capital project fund is reckoning that as a financing source here. So that's how you can, for permanent transfers, just so you're understanding there. And then the other thing is here, just remember here, you have to determine your outflow, what's going out here. So that you have to determine what fund is having the outflow, and you have to determine what fund is having the inflow here. So that'll really, you just lay it out here in T account form, get a little better understanding, understand what's going on in your cash accounts here when you're making those transfers, and then you just have to get your account titles correct here. So just remember what the account titles are for the temporary funds here, the due from and due to accounts, and then for the permanent transfers here, this is where you're going to have financing uses and financing sources accounts. Okay, so that'll end our discussion. Now let's look at closing out our accounts in the example that we've gone through. Now this would be the end of the period closeout or the end of the year. Now in governmental accounting, you're going to close out your budgetary accounts, your nominal accounts, and any encumbrances that you have. So we're going to look at our closing entries for our general fund that we've just went over here. So for closing out our budget, well, we talked about that before. We're going to have our estimated revenue control here. You just reverse all your entries that you would have here for the budget here. So we'd have our estimated revenue control, reverse that out here. Our appropriations control account, reverse that. And any estimated other financing sources, reverse that. And any estimating other financing uses, just reverse that out. And then any budgetary fund balance that you have, that would also be closed out. So budgets, just reverse out any balances that you have in those accounts. Okay, so now let's go over here and looking at closing out the nominal accounts and our encumbrances to the unreserved fund balance. So this is the key here. This unreserved fund balance, that would be similar to the retained earnings for a for-profit company. But for we're talking about governmental accounting, we call it an unreserved fund balance. So what we would close out for those nominal accounts, this is where you're going to have that revenue control account. That's similar to the revenue here for the income statement for profit company. In this case, we had 117,000 here. Then we take and look at our expenditures control. Again, that would be similar to the expense here for a for-profit company on the income statement. And we're going to have an $81,500 balance in here that we're going to have to close out. And then we have this other financing uses control. That was that transfer, and that we had a $2,000 transfer here. We'd be closing that out. So netting all those out, we're going to come up with $33,500 here, close out those nominal accounts. Those are going to go into the unreserved fund balance. It's going to increase our unreserved fund balance by $33,500. And then the last thing, we have this encumbrances control. Now that's going to be closed out to the unreserved fund balance as well. And those are for those encumbrances reserved for those purchase orders that were outstanding here. In this case, we had 5,000 here. So we would have closed that out here, debited or credited our encumbrances control for 5,000, and debit or increase our unreserved fund balance here by 5,000 for the encumbrances. So net amount sitting in the unreserved fund balance here is $28,500. Now this all assumes that we started out with a zero balance for the year here for all our accounts here, for our example. But this is just going over here. We're looking briefly here at governmental accounting and what you would be closing out. So just remember here, for those nominal accounts, you're going to have this revenue control that acts as your revenue here. Your expenditures control that acts as the expenses here. And then if you had any other financing uses here, you would also have to include that. And then also looking at those encumbrance control account here, whatever's sitting in that would also have to be moved over into the unreserved fund balance. Okay, so that'll summarize our example here using this governmental accounting and for our closeouts here for the budgetary accounts, the nominal accounts, and our encumbrances.